So guys, now we are going to understand the provisions under the act. That is, we are going to understand the provisions which from which where we can get guidance on the ELP computation. Now, let me also tell you one thing, guys, that when you read that provisions, I would request you to keep also the bare act with you so that you can refer that provisions quickly and you can understand from that the best interpretation one can get is from bare act only. You don't need to understand about the guidance notes and etc. That is the second step, not in the first step. First step, you should always try to interpret from the bare act, right? I have also put down the extracts from the act itself, and I'll be explaining that also, that what that particular extract means about. But I would always request that you keep your bare act with you so that it is easy for you to understand the provisions when we are dealing with that part. Right, I just share my screen where I am going to the mind map and where we will start from the provisions today. As you can see here, I have broke this entire session for this day into three parts, that is relevant provisions, illustrative situations and other concepts. Alright, I am just opening the relevant provisions part. Now, under relevant provisions part, what we need to understand is section 92C subsection 1, and we have to read that with rule 10b sub rule 1, right? What this provides for the methods which are to be considered for computation of the arm's length price. I'll just open that methods. Now, as you all know that there are 6 methods of transfer pricing, right? First, it starts from comparable uncontrolled price method. Second is resale price method. Third is cost plus method. Fourth one is profit split method. Fifth one is transactional net margin method. And the sixth one is any other method. So these are the 6 methods under transfer pricing, under the Indian transfer pricing provisions. Let me put it that way, right? And these 6 methods can be found commonly under most of countries like European countries, or even in UAE also, where recently transfer pricing has been introduced. Then in the UAE also they have given this 6 methods through which you need to compute the arm's length price, right? I hope that clarifies. Now, we'll start with comparable uncontrolled price method. So guys, before getting into the core provision part, let me just explain what is comparable uncontrolled price method. Comparable uncontrolled price method, or we say cups, right? We usually term it as cup. Now, under the cup method, what happens that generally it is applied when you are able to fetch the uncontrolled data, the transactions. So uncontrolled transactions have the same or similar arrangement compared with the your control transaction, right? So in that cases you use the cup method. So it could be in the areas of certain products, when you sell some finished product, then you can find the cups in that particular scenario, or in case of services also, in certain cases of services you may find cups. We'll understand first what the legislation says about arriving at ALP under the cup method, and then we have a different session for some illustrative situations where you can use you'll understand how to use the cup method and which situation you can use the cup method. I'll just open that particular part. Now, as you can see here that this is the extract from the act. We are reading that, we are interpreting that. So what section 92C1 read with rule 10B1 says that to arrive at arm's length price under cup method, you have to follow the steps. So what are these steps? So first step is we need to identify the price charged or paid for the property transferred or services provided in a comparable uncontrolled transaction or number of such transactions. So first you need to identify that particular transaction which can be comparable with your controlled transactions under cup method, right? It could be the price charged or paid for the property transferred, or price charged or paid for the services provided, right? So you need to identify that transaction first where this has which can be compared with your control transaction. So that is first is identification step. The second step is about adjustment. So what it says that such price, such price which you have identified as comparable needs to be adjusted to account for differences, if any, between the international transactions, that is a control transaction, and the comparable uncontrolled transaction, or between the enterprises entering into such transaction which could materially affect the prices in open market, right? So if you think that okay, this transaction is comparable, but however you are required to make some adjustment to that comparable transaction right? Then your and that adjustment technically, so there could be minor changes, but in case if it majorly affects that price, then you need to adjust that price so that you can compare that price with your price of international transaction, that is transfer price, right? Let me also just reveal you one fact that whatever adjustments have to be made, they are to be made on the third party prices only. We don't make adjustments on the transfer price. So that is, fundamental core regulation or core understanding when you are dealing or when you are making adjustments. Adjustments are to be made on the comparable prices only. They are not required to be made under the transfer price. Yes, you don't have to change your transfer price so that it gets compared with the comparable transactions, right? Whatever adjustments you are required to place, you have to place that with the comparable transactions. You have to do that with the comparable transactions price only. I hope that that clarifies. Now the third step is that adjusted price arrived is compared with your price of international transaction. That is what the third step under the CUP method is. So this is a theoretical aspect which has been given under the Act. We will just now move ahead with the second method, which is resale price method, right? So under CUP you have to compare direct transaction or property. So you have to compare the transaction. So how you will compare the transaction is that you have to identify the prices, you have to adjust that prices, and then that adjusted prices becomes your arm's length price, and that arm's length price is compared with your transfer price. All right. Now we come to resale price method. Now what resale price method says. So now in case if you need to arrive ALP by applying the resale price method, then it has 5 steps. What are those 5 steps? So first, the price at which property purchase or service is obtained by the enterprise from associated enterprise is resold or are provided to unrelated enterprise, right? Now you have to identify that price at which the property or service has been resold to unrelated enterprise, right? That is where first step lies. Now what is the second step? That such resale price is reduced by the amount of normal GP margin accruing to the enterprise or to an unrelated enterprise from the purchase and resale of the same of similar property or from obtaining and providing the same or similar services in a comparable uncontrolled transaction or number of such transaction. So such price needs to be reduced from the arm's length gross margin. Let me just easily put that way, right? Whatever the gross margins that entities, the comparable entity or the comparable whatever the gross margin has been earned under that comparable transaction, you have to reduce that particular amount of margin, right? Then after we come to the third step, that the price so arrived is further reduced by the expenses incurred by the enterprises in connection with the purchase of property or obtaining of services, right? Now here you need to understand that whatever, so first you found out that the price at which the property purchase or service is obtained by the enterprise. So in the first step, you found out the resold, the value at which the product or service was sold. Then you reduce the gross margin. Then after the third step, you are also reducing the expenses which you have incurred in connection with the purchase of that particular property which you have resold to the third parties in the market, right? You have to reduce that price also. And in the fourth step, the price so arrived at is adjusted. So you have to make the adjustments on account of, there could be adjustments on account of functional and other differences, including differences in accounting practices, and if any between the same and the comparable uncontrolled transactions. You have to make such adjustments. That is the fourth step. And under the fifth step is basically you are arriving at an arm's length price, right? I hope that clarifies. Now in case if you still have a doubt, I have prepared one a very simple understanding of this entire resale price mechanism, because I understand that the interpretation of these steps are a bit more on theoretical aspects compared to the practical things. It happens in practical the same way only, in the same manner, but I have broke it down and I have interpreted in the way it should have been, the way in which they are easy to understand. Now let me just open that. Okay. So now ALP in relation to purchase of property of services in case of resale price method. Now first you have arrived at the sale value of the goods which you have resold, goods or services which you have resold. Then you have reduced that with the arm's length gross margins. That is a gross margin which the entities would have which would have earned under the normal scenario, right? Normal uncontrolled scenario. And then you have to, so the resultant price, then you have to reduce the expenses incurred in connection with the purchase of property or services, the direct expenses which have been allocated with respect to such purchase of goods or services from your AE, right? And then either you have to reduce or add the adjustment, you have to adjust the comparable prices. So yeah, that adjustment effect will come here, and then appropriately you will get the arm's length price of your transaction, right? Now this is what the concept is of resale price method. Now we come to the third method, which is called cost plus method. Now guys, also before moving to the third method, I just wish to introduce one thing here. So in first method, what you did, you had a direct price which can be compared with the uncontrolled transaction, right? There was a direct price which was available for comparison between a comparison of uncontrolled transaction with the controlled transaction. Under the second method, you have been introduced to the concept of gross margin, right? Now here the resale price method, so under resale price method you need to understand that there is some role of gross margin, arm's length gross margin. It is not net margin, right? And that is also where specific formula has been given for that. So first you have to arrive at a sale value, then the margin which have been under the normal circumstances, then you have to reduce also the cost of the direct expenses which you must have incurred. And then in the next step you adjust the prices and you arrive here at your arm's length price for your particular purchase transaction, right? So this is the concept of gross margin which has been introduced, right, in the second method. Now we move to the third concept, which is called cost plus method. So third type of method, cost plus method. Now as I have marked here the clause, so how do you arrive at a cost ILP under cost plus method? So the first step is you identify the direct and indirect cost of production incurred by the enterprise in respect of the property transferred or services provided to an AE, right? You need to identify the direct and indirect expenses, that is cost of production or cost of providing that services, right, to your AE. So that is the first step. The second step is the amount of normal gross profit markup. Again, you have to, so on that expenses, so under resale price you did the reverse way computation, right? Under cost plus method, you will start from the cost of production or cost of services rendered, then you will add the gross profit markup to that, and then you have to adjust that gross profit you have to make the adjustment under the third, and under the fourth step you arrive at the adjusted profit markup, that is the cost plus the gross profit. You arrive at the sale value, technically sale of service or sale of product, right? So the sum so arrived is taken to be at arm's length price. The fifth step is that post adjustment and post adjustment adjusting the profit markup, you arrive at a arm's length price. So this is what cost plus method is all about. I hope that clarifies. These are just theoretical concepts that we are learning right now. Practically we will see that how this method needs to be applied. I'll just move on to the further part. Now again, also in this method also you saw that there is a role play of gross profit and gross markup which is coming in this entire extract once when you learn that. So under resale price method and under cost plus method you have to deal with the gross margins technically, right? I just moved to the next part, which is profit split method, which we call as PSM technically. So now when the profit split is when is the profit split method used? So first the clause D, subclause D says that profit split method applies or which may be applicable. So to arrive at a profit split method, first you need to check its applicability. You cannot everywhere apply the profit split method. So profit split method which may be applicable mainly in international transactions which involves transfer of unique intangibles, or in multiple international transactions which are so interrelated that they cannot be evaluated separately for the purpose of determining the arm's length price. So this thing you can know from the supply chain and from the factual part of that transaction, that whether the transaction which has been undertaken by your client with its A is so interlinked that it cannot be evaluated separately. So in an entire supply chain there could be a different type of functions. So it is not every time that every transaction is interlinked. You can identify that and you can evaluate that transaction and you can do analysis separately. But where when you are developing some intangible, you are doing some R&D activities with your other partners, that is related partners, then in such cases you can apply this method, but this will be tested. Now what are the steps of computing the ALP? Will go one by one under the PSM, that is profit split method. So the first step is the combined net profit of the associated enterprises arising from that international transaction in which they are engaged is determined. So you have to determine the combined net profit, right? So you have to also here understand the profit which is being earned by your associated enterprise and by your client company, and then you have to combine that, right? Then the relative contribution made by each of the AE to the earning of such combined net profit is then evaluated on the basis of the functions performed, assets employed or to be employed, and the risk assumed by each enterprise, and on the basis of reliable external market data which indicates how such contribution would be evaluated by unrelated enterprises performing the comparable functions in similar circumstances. So I need to segregate the contribution between the A's basis their functional analysis. It is easy to understand, right? So I need to segregate that. So that is where my functional analysis will play important role, right? Whether there could be, so you need to delineate the profile of these two parties to the transaction, and appropriately you need to understand that whether in uncontrolled circumstances, if these parties would have done the transaction, then what they would have earned, right? That is what it means. That's step number 2. Then the combined net profit is then split among the enterprise in proportion of their relative contribution. So you have arrived at that market data, and that appropriately you distribute that profits, right? And the profits thus apportioned to the assets is taken into account to arrive at an arm's length price in relation to the international transaction. So whatever resulting profit you get, your client taxpayer gets, that is taken into account to arrive arm's length price. Now there is also one provision to this entire subclause which reads that, provided that the combined net profit to in subclause 1 may in the first instant be partially allocated to each enterprise so as to provide it with a basic return appropriate for the type of international transaction in which it is engaged with reference to market returns achieved for similar types of transaction by independent enterprises, and then after the residual net profit remaining after such allocation will be split among the enterprise in proportion to their relative contribution in the manner specified under subclause 2 and 3, and in such a case the aggregate net profit allocated to the enterprise in the first instance together with the residual profit is apportioned to that enterprise on the basis of relative contribution shall be taken to be the net profit arising to that enterprise from the international transaction. So it says about two concepts, right? Now we just break that proviso as well. This is the manner in which you can you need to attribute the profits between the entities when you to arrive at a arm's length price. So under the first instance, that is under the first scenario or first step, what you have to do is you have to partially allocate to each enterprise so as to provide it with a basic return appropriate for the type of international transaction in which it is engaged with reference to the market returns achieved for similar type of transaction. So there are two steps to arrive at arm's length price, two sub steps, or you can say two further more steps apart from the 4 steps which we read above. So under the first steps, whatever as per the market needs to be allocated, on the partial, so you have to do a partial allocation of this profits between the entities considering the market data, and the profit, the residual profit which remains after that partial allocation, alright, in certain instances. So now let me just give a practical example that there are A and B, two enterprises, they are developing some intangible. Now A has incurred some cost, B has also incurred some cost, right? So and they have developed that intangible, now they are earning from that intangible, probably they have sold that particular product or intangible, right? Now what will happen that, now if there will be a sales, there will be a profit. Now first, once the amount comes, right, the transfer price, so how will you determine the arm's length price in this scenario? So first, whatever the cost, I'm just explaining in simple terms, in the real situation it may be different, okay? This is just for understanding the concept of this particular 2 steps which are there under the provision. So under the first step, when a sale has been made to the third party by these two entities who are of the product which has been developed by these two entities, right? A sale has been made. So obviously amount would have been received by that particular entity. Now these entities have also incurred cost, right, to develop that product. Now first is basis the roles of these two entities in developing that product. You must have got the market data that in uncomparable scenario, what margins would have been earned by third parties by performing those roles in the uncontrolled scenario. So there would be a cost and there would be a margin of which would have been which needs to be applied on that cost part, right? So whatever resultant figure which you get, cost plus margin for enterprise A and cost plus margin for enterprise B. So margins could be different, the cost could be different, right, for enterprise A and enterprise B. So whatever that total amounts and whatever that being allocated out of that sale amount, you need to reduce that, right? First need to distribute that particular part. So that is what partial allocation means of. Now what remains? The balance portion, right? And that balance portion again needs to be allocated basis, the relative contribution that shall be taken into account, right? So on a prudent basis, on a relative contribution, that which party has contributed more or less, on that particular basis you can distribute the residual amount. This is what this entire provision means. I hope that clarifies. It is easy to understand this profit split, but the provisions, from cup method till entire last method, transition margin method, the provisions have to be worded like this, so that the concept and fundamentals remain at their core area. They cannot just itself introduce provisions which is very vague. They have to be specific. So whenever you test this method or whenever you apply this type of methods, also do check on the provisions that you are you are following all the provisions, right? Once when the practical case comes up, you will be able to know that what method to be applied. Easily you will able to come to know. But still go through the provisions once, and then appropriately you can take the positions ahead, right? Now we'll just move ahead to the next method, which is transactional net margin method. Now what is that method? So this is the most favorite method of all the people. You must have also heard about many times from the other consultants as well, TNMM, and everywhere most of time this method is commonly applied, right? Why? Because this method has its own characteristics. We'll come to that part, the illustrative situations when this is to be applied, but for the understanding of the from legal perspective, I am explaining you that how to arrive at ALP under TNMM. It is easy, right? So from the first part, so first step is arrive at a net profit margin which has been realized by the enterprise from the international transaction entered into with an associate enterprise, is computed in relation to the cost incurred or sale effected or assets employed or to be employed by the enterprise or having regard to any other relevant base, right? So there are certain terms here, right? First you have to arrive at a net profit margin which has been earned by your taxpayer, that is enterprise, from an international transaction which it has done with the other party, that is other your associated enterprise, and you have to arrive at a margin considering the relevant base, right? The last 3-4 words of this or the last phrase is any other relevant base. So you have to have also a base, correct, to compute that margin. So you need to arrive at a profit margin. Let us now just take in a simple sense. Now the next step is you need to arrive at a net profit margin which has been realized by enterprise on or by an unrelated enterprise from a comparable uncontrolled transaction, or number of such transaction is computed having regard to the same base. Now you have to keep the same base and you have to arrive at a net profit margin. Base means technically base is denominator. When you compute a margin, then there could be operating profit divided by sales, right? So sales become the base, right? So if you have taken the base as sales, then under step 2 what you are required to do is you have to arrive at a net profit margin realized by the enterprise in an uncontrolled situation, right? So second step is first you computed your margin, that is your taxpayers margin. In next step you are computing the margin under uncontrolled scenario, correct? Now in the third step what you are doing is that the net profit margin referred to in sub clause 2, that is the margins which would have been earned by the enterprises in an uncontrolled scenario. So is adjusted to take into account the differences, if any, between the international transaction and the comparable uncontrolled transactions, or between the enterprise entering into the such transactions which could materially affect the amount of net profit margin in the open market. So you have to do certain adjustments, right? So this is what the third step is, doing the adjustments. First is you identify your own profit. Second is you identify the profit under uncontrolled scenario. Third is you place the adjustment. Fourth is the net profit margin realized by the enterprise and referred to in subclause 1 is established to be the same as the net profit margin referred to under subclause 3. So that margin compared with the adjusted net profit margin needs to be same. That is what step number 4 is, has to be adjusted so that both the margins become same. And fifth is the net profit margin thus established is taken into account to arrive at arm's length price in relation to the international transaction. That is how you need to arrive at arm's length price for that international transaction. Now let me just put it this way. The transfer price will be different and the net profit margin will be different. You have to compare those net profit margins, and before comparing you have to adjust the net profit margin by the enterprise under uncontrolled scenario, and then appropriately you have to arrive at your arm's length price. So from transfer price you have to arrive at arm's length price. The margins are not arm's length price or transfer price, right? Margins are the indicators which shows that either your transfer price is at arm's length or not. So that is where you need to compute the ALP, right? So fifth step will be always computation of ALP, arm's length price, in that scenario. So theoretically it means you need to do entire this steps, and then appropriately you can arrive at arm's length. I hope that clarifies. Now the sixth method is actually, it doesn't provide for any mechanism, but it's an other method. So where you are not computing the ALP under these 5 methods, you are not able to compute the ALP under these 5 methods, then you can go ahead and you can use the other method also. So this was introduced, I think 2012 or 2014. I'm not sure about the year in which this other method was introduced, but yes, before that you had only 5 methods to benchmark the transactions. I mean, the taxpayers had only 5 methods to benchmark the transaction. Now with the introduction of other method also, it is easy for taxpayer to take position also that they can go ahead and use the other method, because under these 5 methods in certain transactions it was difficult to apply any of the method, and then the results were very vague. So this method was introduced under this act. Now we'll just read that. For the purpose of clause F of subsection 1 of 92C, which says about other method, the other method for determination of arm's length price in relation to an international transaction shall be any method which takes into account the price which has been charged or paid or would have been charged or paid for the same or similar uncontrolled transaction with or between the non-associated enterprises under similar circumstances concerning all the relevant facts. So it gives the freedom that you can take the price with you can if you are not able to determine your arm's length price using the above 5 methods, then you can use this method and you can get the market data, and you can use that market data or the data pertaining to the uncontrolled transaction, and you can select that data and you can compare that with your transfer price. So this is what other method is all about. All right. So I hope I have clarified the theoretical aspect of section 92C1. I will move to the next topic in the next video. Till then, enjoy, relax, and thank you.